Good evening, good afternoon, and good morning, and welcome to this live CoinDesk webinar on crypto options, where we will dissect volatility trends and discuss profitable trading strategies. My name is Nick Lord, and I'm the moderator of today's event. Today's discussion is based on a groundbreaking study that has just been released. It analyzes 4 years of crypto derivatives data. This is the longest data set and the biggest piece of analysis that has come out on this subject. And the insights gained from this study will prove invaluable to anyone who is looking to trade this burgeoning asset class. We're delighted today that 4 of the 5 authors of this report are with us today. And I'll now introduce them. First, Euan Sinclair. Euan has 20 years of professional option trading experience. He holds a PhD in theoretical physics from the University of Bristol and has written 3 books: Volatility Trading, Option Trading, and Position Trading, all of which have been published by Wiley. He's also published numerous other papers and articles. Next is Samneet Chepal. He's a quantitative researcher and trader with a specialized focus on cryptocurrency option markets. He's a portfolio manager with LedgerPrime and began his career with KPMG. He's a master's in data science from the University of British Columbia. Next, we have Greg Magadini. He's the director of derivatives at Amberdata. Previously, he was the co-founder and CEO of Genesis Volatility, which is a pioneer in the crypto options space. Prior to that, he spent a decade as a trader for major prop firms such as DRW, Chopper Trading, and SMB Capital. He has a bachelor's in economics from UC San Diego. And last but by no means least, we have Fabio Bassani. He is a crypto volatility trader and data scientist at Amberdata Derivatives. He was previously also at Genesis Volatility. Fabio holds a degree in economics and statistics, and he's been in crypto since 2013. So we have an absolutely fantastic panel of experts to talk about this very exciting topic. How we're going to structure today's discussion is that it will be in broadly 3 parts. Firstly, we're going to outline how the report was put together and some of its key findings. Then we will take a broader look at some of the key characteristics of the crypto options market that have been revealed by the report. And then thirdly, we'll do a deep dive into some of the trading strategies that the report has backtested and most importantly has found to be profitable. So I just want to remind the audience that this is an interactive webinar. There is a Q&A function. If you just click on the bottom of your screen where the question is, those questions will come to me. We will either address them as they come in, if they're relevant to the conversation as we're having it, or we will address them at the end. But please do feel free to send in all your questions. So we've got a lot to cover. Let's start. Greg, let's start with you if that's okay. Perhaps you can tell us about the data set and the different regimes that you've analyzed for the report and some of its broader findings.
Yeah, absolutely. So first off, I just want to thank Deribit, the exchange. All this data is built around Deribit's data set. We started with a volatility surface going back to April 1st, 2019. And so we have 1 hour granularity is sort of the base of our analysis. And so we look at the spot prices, we look at the forward prices, so we can see sort of the basis, the futures basis. Then we look at the volatility surface on top of that. And so we analyze the term structure, which is sort of the at-the-money vol of all the different expirations. We analyze the risk reversal skew with 25 delta, 35 delta, 15 delta. And we look at that data set from April 1st, 2019, all the way to December 31st, 2022. So if any of you guys have been in the crypto space for a while, there's a lot of different crypto regimes or environments during this data set. So the end of 2019 was really the end of the bear market. 2022 is when Bitcoin started to come back to life. And in early 2021, we had sort of a peak bull market. And then 2022 has been sort of a bear market again. So we have a nice sort of full cycle bear to bull that allows us to kind of gather some insights from the volatility surface over that time period.
Great. Are there, perhaps you can share with us some of the key findings from the report, with the slides.
Yep, absolutely. So some of the things we'll review today during the webinar, so we're going to look at some of the term structure analysis. Fabio and I did sort of a dissecting of how long does the term structure remain in backwardation when we have sort of vol shocks. We also look at the risk reversal skew. We've had sort of different environments there. In the bull market, we've seen a positive risk reversal skew. For anyone who doesn't know what that is or how we look at it, we look at the 25 delta call minus the 25 delta put. And so if the surface is symmetric, those should be equal. And we've seen regimes where the call side is more expensive than the put side, and we've seen regimes where the put side is more expensive than the call side. And so we use that as sort of an overlay and a filter, and we analyze sort of that type of environment. And then we've done some insights around the variance risk premium, how expensive are options versus realized volatility? Does it matter if we're in different term structures or risk reversal skew sort of environments? And so we use those as filters and signals. And then finally, Samneet did some back testing using one of Euan Sinclair's white papers that he created for equities around some of these strategies, especially around the risk reversal skew, to see if we can profitably trade Bitcoin vol with this type of strategy.
Great. I mean, one of the things I found most interesting from the report was maybe the comparative elements of as you said at the beginning, we've been through a few different environments. So, crypto options behave in some cases like commodity options, in other cases like equity options. Can you give us some insights there?
Yeah, so that's the way that I really like to kind of classify it. So anyone who's traded equity vol knows that pretty much stocks will crash quickly and sort of rally up more slowly, especially true with indexes, which have a diversification component embedded in there. Commodities are a little bit different. If you think about natural gas, no one cares about natural gas at $2. It's just one of those things that's kind of in the background. And then you get some sort of like geopolitical shock, and all of a sudden, natural gas goes from $2 to $9. And so that vol regime is sort of an upside vol regime, kind of like what we see in a FOMO environment for Bitcoin. Sort of the same thing in Bitcoin. When Bitcoin's crashing or floating down, no one cares about it. And when it's rallying up, everyone's Googling Bitcoin and how to buy Bitcoin. And it's kind of it creates a crowd who wants to get long Bitcoin. So you have these sort of violent upside moves. And in 2022, we've seen kind of big surprises. We had this Luna crash. We had Three Arrows Capital basically going bankrupt, and we had FTX basically being a fraud. And all those things were huge downside vol shocks. So it's kind of interesting to see it go from a natural gas-like environment to an equity-like environment throughout the past 4 years.
Very interesting. Euan, perhaps you can put this in wider context by maybe comparing crypto to other TradFi options markets that you've traded over the past 3 decades.
Yeah, I think the big challenge with crypto is while we've analyzed the biggest data set there is, it's not really a very big data set. We've only go back to 2019. Now, I know in crypto that's an age, right? 2019 was before the DeFi revolution. It was before all these doves and so forth. And we do see different regimes. Without a doubt, we see bull markets, bear markets, volatile markets, and so forth. But we don't see multiple examples of each of them. So it's very difficult to draw very hard and fast conclusions from that. I think it was interesting that Greg said it flips between equity-like and commodity-like. That's not the dumbest thing I've ever heard, but I'd push back on it a little bit in that I think it's much more commodity-ish all the time. When you're trading equities, you can literally trade equities only knowing the ticker of the stock. You don't need to know the name of the stock or what the stock does. It's all statistics based. Commodities aren't like that. You really have to know what's going on. If you're an oil trader, you can't just jump into natural gas because they're fundamentally different. And I think that's one of the things about Bitcoin as well, is you benefit from domain-specific knowledge. So I think the short data set can be seen as a disadvantage. But I think as a trader, it can also be an advantage, because the real sweet spot to me as a trader is when you see evidence for something, but not statistically massively overwhelming evidence. So this isn't like equity markets, whereas the study we've done here on the risk reversal, I did in the equity markets going back 15 years. You can almost prove these things statistically significant. And that means sort of the trading edge is gone. Everything that's left is beta. Whereas here, I think as a trader, you can say, look, I know how this other market behaves. How do I apply that to Bitcoin? Because it looks similar. And I think that's a huge advantage. One of the best ways to make money as a trader is to see what's happened in another market, or even what's happened in the same market at a different time. Like in a lot of ways, we think of crypto as the future, and technologically it probably is. But from a trading perspective, a lot of it's the past. You ask yourself, how did equities behave in the crash of, like, I don't know, 1996? And say, what can I apply from that to Bitcoin? So I think it's really exciting for that. So you have to look at this as both a disadvantage and an advantage.
Okay, yeah, super interesting. And Fabio, perhaps you could talk in a little bit more depth about the crypto options market's characteristics, including the calculation of term structures and things like that, without reference to the report, but just sort of more deeply go into how this market actually looks.
Yeah, sure. When we started to work at the report with the goal to categorize the different volatility regime, we had one goal that was to calculate at quantitative level the richness of the term structure. Term structure usually is an amazing tool and a very convenient tool for traders to have a quick look about all the at-the-money implied volatility across different expiration. Just one look at the chart, you have everything under focus about the options market. It's a caveat, there is a caveat though, because with the term structure, you have one picture of the market. So with this goal in mind to build some way to categorize the volatility regime, we start building a new methodology to calculate a synthetic value for the term structure in a specific daytime. So in this way, we were able to build a time series, basically, a time series of term structure to compare it through times. And we came up with a lot of ideas. Me and Greg compared a lot of different ideas, and then with Euan, with a valuable suggestion from Euan, we realized that we decided that a good matrix could be the average ratio between all the combination of the expiration. Just one point important, we used constant maturities. So we don't use, of course, specific maturities, but we use constant maturities. So 7 days, 30 days, 60 days, and so on and so on. So with this average ratio, we built a good matrix to evaluate across all the term structure the steepness of the curve. And usually we have two states of the curve. A curve is in contango when the front expiration are lower than the back end expiration in terms of implied volatility, or in backwardation when you have the front maturities that are higher implied volatility compared to the front back. And with this new data set we built, we were able to build any statistical analysis about these different regimes of term structures. So we calculated, for example, the number of times the term structures, the different term structures in time spent in backwardation compared to contango. And we found that around 80%, specifically 78% of the times with hourly granularity data, 78% of the time is in contango. So we can say that contango is the normal state of affair of the options market. But when we see a spikes in volatility, so traders start to trade frenetic in the front part of the curve, we have a backwardation spike. So we see in the, maybe we can see the chart in the repo as well.
I think that's page 7 for the 7 or 8.
8, yeah, I think 8.
Can we pull it up? I don't see it here.
Yeah, we saw that spike at 145 that occurs specifically when we have the spikes in implied volatility, like a major downside events like March 2020, May 2021, June 2022, and November 2022. So, and these spikes in the term structure, in the curve of the term structure, means that it was very backwardated, very steepness, because the front part of the curve was very high compared to the back end part of the curve.
And can I just confirm that that's vol as opposed to price?
Yep.
Yeah. Okay. Okay. Do we have chart 7 that we could talk through as well? Because there was some interesting.
Of course. About 7. Yeah, we calculate as well since the backwardation is the abnormal state of affairs, let me say, we calculated the time spent in backwardation. So volatility traders could use the time to leave measurement to estimate when the volatility could revert into contango. And we found that this value is around 85 hours. So we found that after 85 hours on average, the backwardated term structure reverts in a contango normal state. It's very interesting. It's a very peculiar way of looking at volatility, and that's it.
Yeah, just to jump in on this. So, the reason why Fabio and I thought this was interesting is because when you have a vol shock and you go into backwardation from contango, it's very tempting to want to sell vol, because at some point things will calm down and come back. So quantifying how long or how many hours time to live that we are in this sort of vol shock backwardated environment, it really helps you kind of create a parameter in your mind around, how long are we going to stay like this, and when typically do we come back and settle back into a contango structure. And if you can get that right, those are pretty good opportunities.
Yeah, exactly. Avoid the big drawdowns, and you're in good shape. Euan, what's your take on this? And perhaps we can explore some of the sort of risk reversal skew charts. Buying the put in crypto is relatively cheap. Is this something that we see in equity? I think these are issues shown on 11 and 12.
Well, in answer to your general question, no, it's not something you ever see in equities. Right. Everyone wants puts. Puts are insurance. There's no great mystery. You pay for insurance. The cheaper in dollar terms the puts are, the more expensive in volatility terms they are. And this is almost as close to a universal law of nature as we have in the volatility space. And we don't see that in crypto. And
why is that?
That's a good question. I think a lot of it comes down to the fact that crypto behaves a little bit like a meme stock. So calls, everyone knows puts provide insurance, but calls do as well. They provide insurance against FOMO. No one wants to be the moron who misses out on the rally when crypto goes back from 20,000 bucks to 80,000 bucks or something. So calls are a very appealing instrument for that. So you definitely see buying pressure in the calls as well. And one of the really interesting things that Amberdata is doing is tracking who's exactly buying which option. Like, is retail buying calls, is retail buying puts? And you can get a lot of, I don't know, insight from that. I think it's really fascinating, going back to what Greg said about the contango thing. Like he said, everyone wants to sell the spikes, but selling those spikes is almost like trying to catch a falling knife. Yeah, you know it's overpriced, you know it's going to come back, but you're going to get killed before it does. So the trick there is you wait until it is coming back, take those 85 hours, go to the pub or whatever, and then when it comes back, as it goes back into contango, you've got a chance to sell it there and ride all the way down, because we definitely see a relationship between variance premium and the contango, which is a great signal, which you see in equities as well. And it's a very consistent thing.
We've got quite a lot of questions coming in from the audience. Do we have an idea of what triggers these volatile events? I suppose these points where it goes into backwardation and then comes back. Can it be anything? Is there anything in particular, or is it anything and everything?
Yeah, so there's kind of like obvious triggers. Like we had the crisis. Let me just go back to this chart real quick. We had the COVID crisis in March 2020, where basically everything got destroyed. So you can see that right here, sort of between Jan 2020 and July 2020, you have that big spike.
Yep.
So that's pretty interesting. That's kind of an obvious one. The one that isn't so obvious to me, and feel free to disagree, anyone, is sort of the January 2021 event. So again, just sort of like the meme stock example. This is really one of those environments where people were FOMOing into calls because you have Bitcoin breaking into new all-time high territory once again at the Q4 of 2020. And then there's sort of like, what's the ceiling on Bitcoin? How do you value this thing? There isn't a clear ceiling. And so this thing can go on for a long time on a rally. And so we sort of had a contango environment triggered by a positive price action. The other ones, the other spikes we see are Luna, 3AC, FTX, and a major pullback in May 2021.
Interesting. So it's sort of CeFi infrastructure blowups that tends to be translated into increased vol.
Mm-hmm.
Were you surprised by how often the term structure was in contango versus backwardation? One key divergence from commodity-like behavior is that most energy vol services are typically in backwardation, given the producer flow back-end vol selling. Do you expect that to occur in crypto over time? Perhaps that's a question for you, Euan.
That comes back to the specific nature of each commodity, I think. And I think that's one of those things you just have to say, yeah, Bitcoin's not like that. It's not like oil. I mean, we don't have, oil is a very interesting market because you have massive producers who have to sell oil and you have massive consumers who have to buy oil. We don't really see that to the same degree in Bitcoin. Like, no one really needs to buy Bitcoin. So the buying and selling dynamics is different. So if I had to bet, I would say we would continue to see this type of term structure persist.
Okay. Well, I think we're already way behind time, but let's go more deeply into some of the trading strategies that have worked. And we're going to come back to some of these specific questions that are coming through on the chat function about some of the sort of specific nuggets within the report. But I think we want to bring in Sam now, and we want to go more deeply into trading strategies that have been revealed. Sam, what can you tell us about, firstly, risk reversal strategy, and specifically how to harvest BTC's risk reversal premium?
Yeah, for sure. So the majority of this backtest in particular for the risk reversal premium came from Euan's original paper, which he sort of replicated in traditional equities on S&P 500 options. And what he found in that paper, and correct me if I'm wrong, Euan, he found that selling puts and buying calls and hedging them in a portfolio appeared to offer pretty strong risk-adjusted returns for the same reason of there's always downside demand in traditional markets, especially after the 87 crash. The put skew has always sort of been bid up because no one wants to get destroyed from any sort of single black swan event. So using that sort of as a base, we wanted to replicate that same backtest in crypto, specifically for BTC options. And we found actually the reverse was true in the sense that selling calls and buying puts actually vastly outperformed the latter strategy of what Euan found in his paper. And this is for the same reason of what was mentioned, in the sense that there's a lot of FOMO in the crypto space, especially when the bull market starts getting up and running. And as a result of that, no one really cares about how much they're going to lose on their downside. Rather, they're more focused on the fear of missing out. So as a result of that, call skew tends to get bid up quite high. And we found that in the backtest in itself, that even over like a variety of different regimes for skew, that that sort of persisted over time in a systematic manner. And it offered sort of the best risk-adjusted returns when we were looking at around a 1 month 35 delta risk reversal by selling the call and buying the put and hedging it on a continuous basis. Yeah.
What kind of returns were generated from that?
So total returns was around 40% throughout the period. But more importantly, I think it's more useful to look at the Sharpe, because that is able to sort of get an understanding of the risk-adjusted nature of the strategy itself, and it's easier to compare against other strategies as well.
Okay. And given that, how replicable is that in the real world, would you say? It's one of those things which works in theory, but can it work in practice?
Yeah, so I think it really depends on, like, even in traditional markets and especially in crypto, I think one of the key things to get down right is execution and getting your order management down right. I think that is sort of the make or break of any sort of option strategy. And I think if you have a very solid order management system, that in itself will significantly help you to be able to actually extract the alpha from this strategy. Whereas if your execution is very poor, I mean, I don't think it would work. But I think the overall phenomena that we saw here is definitely something that can be exploited in the future bull markets to come.
Okay. And how about other sort of traditional options trading strategies, butterflies, straddles, things like that? Do they work in the BTC options environment as well, or is that inverted like it is with risk reversals?
Yeah, so interestingly, that was another backtest that we actually explored, or another research study, where we wanted to see whether we could sort of harvest the variance risk premium. And what that means is that typically implied volatility tends to be overpriced by the market. People are always fearful of the fear of missing out or the fear of something crashing. So generally speaking, implied volatility is usually going to be above realized volatility. And as a result of that, whenever that occurs, we can monetize that by selling vol in the form of, as we did in the research paper, in the form of selling straddles. And that appeared to offer pretty strong returns over a long enough time period. And the same could have been done with butterflies as well, provided though that the returns are a little bit lower because we're buying two options on the other ends of at the monies. So that's sort of the theta decay in those sort of eats up in the overall returns. But generally speaking, the variance risk premium does seem to be something that can be monetized in the option space.
That's great. Euan, I want to bring you back. A constant theme throughout this discussion has been cheap puts in the market. How can these be incorporated let's say, into wider trading strategies? We've only looked at it within the context of a crypto trading strategy. Is there something that can be applied here in a wider sort of portfolio context?
Yeah, I think that's the most exciting thing. Like everyone's heard of the idea of you buy teeny puts in fear of a black swan, you know, a rare event. Well, the real rare event is finding cheap puts. And that's what we've done. We've found that these puts are cheap. So it's kind of, you can make money buying them in the Bitcoin space alone, which is nice. But the real thing is they become a positive carry disaster hedge. Like the overall correlation between Bitcoin and equities isn't super high, right?
Yeah.
On the sort of daily level where options sort of matter, it's about, you know, give or take 30%, say. But during the crash of the COVID crash, that correlation nearly doubled. So it's pretty clear in a massive panic, Bitcoin does go down with equities. And that's when that buying cheap puts is really going to kick in and help. Because if everything goes to disaster, puts are really the only things that are going to outperform. So to me, that's the great thing. It doesn't even really matter what you trade. It looks like Bitcoin puts are kind of the bargain of the century.
Okay.
Generational buying opportunity. Isn't that what you meant to say at this point?
Absolutely. Absolutely. A 1 in 100 year, a 10-bagger.
Yeah.
Greg, I'd love to bring you back. We haven't heard from you for a while. Are there any more insights that you can give us from the report itself before we start addressing some of the questions from the audience?
Yeah, sure. If you guys don't mind bringing the slide deck back, there's one slide I'd like to show. All right, thank you. Let me just go back here. So one of the things that we analyzed, and Fabio did a great job with this, is really sort of how is the skew moving with volatility. And so we can see that 2022 has this really tight relationship. And so it's almost kind of setting this precedent. Well, there's two sort of arguments. There's kind of a secular trend, and then there's a cyclical trend. So if we look in cyclical, I mean short-term, secular, I mean sort of the long-term thing. So I think as crypto becomes more mainstream and people view it more and more as a risk asset, it'll start to mimic sort of secular risk asset trends. And that's kind of what 2022 looks like to me. We have this really tight relationship that when vol goes up, the risk reversal is going down. And so you can see the demand for puts as vol goes up. 2021 was the opposite. And then 2019 and 2020 are sort of like no clear relationships to me. Those are very symmetric. So one of the things that really stands out to me is that despite us setting this trend in 2022, the first sort of month of 2023 kind of flipped 2022 over on its head. And now we have sort of positive risk reversals being priced all the way 6 months out. And so this gets really interesting to me because back to selling the call and buying the cheap put, we're sort of getting this opportunity again. And in the short term, skew can do whatever because in the short term, spot prices can do whatever. But when we're talking about 6 months of options, that's pricing in 6 months of a mean relationship. And so to see kind of the 2022 trend being flipped on its head, despite this really tight relationship that we're witnessing on this chart, I think is a pretty interesting opportunity. You get that opportunity to buy the cheap put, sell the expensive call. And then, you know, if we get some sort of crazy macro event, I think the macro still drives a lot of things. If we get, you know, some tail 10% CPI print, you know, Fed hikes 75 basis, I don't know, something crazy, some outlier, I think all the risk assets will take a hit there. And so kind of to Euan's point, if you can own that cheap put, that's pretty interesting.
Okay, fantastic. I think we'll move to the Q&A now. We've got a number of questions. We've addressed a few of them already. First one of the key takeaways of the report for me was just how well being short spot vol correlation has performed over the past few years. Do you expect that to continue? Fabio, how do you answer that?
Yeah, of course, it's a normal state when you have a bear market. And but in the past, Bitcoin and crypto in general demonstrate a positive spot vol correlation, because when you have those parabolic move of the spot price, you have also the spike in implied volatility.
Right.
So it's difficult to say. It depends really on the market regime. We went from 2022, like Greg said, where we had a bear market for all the year, basically, and we have a strong negative vol skew correlation. And it could be different because if the markets and the spot move in another way, we could see like 2021 when we have that big spike in volatility with the term structure backward dated and the spot price moving upside. So very, very peculiar way of the bull market in a parabolic phase. So yeah, I would say that selling calls in Bitcoin markets is riskier than selling calls in a equities market. You don't have usually that move price parabolic.
Do you expect the spot vol correlation to continue?
The negative of the 2022.
Well, I think as Greg was saying, it looks as if the market has shifted.
Yeah, currently it's shifted, but it's more related to the skew. We currently see a positive skew and a positive upside move of the spot market. And I don't know, maybe we can't see anymore those spike. Is just my opinion. In implied volatility with a bull run in the spot. Maybe the market is more mature now. Big players are coming in, so we have a more mature behavior of the market participant. So it could be not.
Okay, maybe their fear of FOMO is less, and it sort of becomes more their fear of downside, which the traditional players might have more of.
Exactly.
So I think we've got a question, another interesting question. I think this one came in when Samneet was speaking, so I'll address it to you, but I think it also you, and I'd love your take on this as well. So it's more of a comment than a question. It says, interesting, that actually this is not much different than what happens in TradFi options. The problem is that short-term options have little to no vega, and so the strikes for strangles or either short calls or short put need to be very close to each other to make it worth it. So again, this is the practical application of a trading strategy. Do you have any comment on that?
Yeah, I'll have a quick comment on that, saying that I guess if you're selling a straddle, you're pretty much just trading at the money. So in effective, like even if you were trading a 1 month or 3 month, you're still going to be trading at the money. But I agree with the fact that you're not really vega trading at that point with a weekly option. You're more of like just trying to capture that theta decay. But I'll let Euan expand if he has any other thoughts.
I think this is one of those things where I'm just going to point to the results of the test.
Yeah.
I mean, the numbers are the numbers. I think it's a little interesting that when I ran this test, I found that the best risk reversal to do was about 15 to 20 delta. And that's because they've got the highest VANA, which essentially is what drives the profit of a risk reversal. Here, we're seeing it is closer to the at the money. So we're seeing like the 35 delta. I think that's because with equities, the risk reversal premium and the straddle premium are almost completely orthogonal. They can be completely separated. Whereas here they're not. We mentioned in the report somewhere that they're actually tied together. So I think by doing the 35 delta, you are getting more exposed to a variance premium as well, as the commenter said. But I think it's probably something that we could do a lot more study on. I'd like to disentangle those effects more.
Okay. next year's study. Greg, what's the fundamental reason for the risk reversal strategy performed better in the 35-day options than the 15-day options?
You know what? I'm actually not sure. I don't really have an opinion on why that is the case necessarily. I don't know if anyone else that.
Anyone want to chime in? No? Okay. Sam, another question for you. Did you get to apply back testing to ETH? Curious if you found anything or general thoughts given the similarity of ETH and BTC in the last years. I think this is a key finding from the report, is the increased presence of ETH options or ETH options in the mix. Sam, do you have any data on that?
Yeah, so we actually only focused on BTC options for this report, but that's a great suggestion for next year's report.
Okay, Greg, I know you've got some views about ETH options in general.
Yeah, well, I think, so this is where Fabio and I like to have our classic argument, what's better, Bitcoin or ETH? I've sort of been an ETH maxi since the days that the ICO sort of launched. But basically, the way that I see it is that we're seeing, especially with the proof of stake merge, we're seeing a lot of adoption in Ether volatility trading. So we've seen a huge increase in block trades. We've seen a huge increase in open interest. That trend has kind of flipped again in 2023 as a disclaimer. We're back to BTC. But 2022 was a big year for ETH volatility trading adoption. And I'm sort of in the camp of a lot of the infrastructure is built on top of Ethereum. And so, for example, stable coin markets, those are super important. They become sort of a pillar of crypto environments and crypto trading. Well, most of those are built on Ethereum. And then if we look at all the sort of the DeFi projects and the DeFi innovation, that's also built on Ethereum. And then all the layer twos are sort of built around Ethereum as well and EVM. And so I'm of the camp that in the long term, I think the financial crypto infrastructure has to be basically preferential to wherever all the developers are, wherever all the projects are. And so I actually think in the long term, we're going to see potentially a market cap flipping of ETH versus BTC and potentially open interest and volume flipping of ETH options versus BTC options.
I think the analogy I would use there is it's similar to saying this is how oil behaves, so this is how natural gas is going to behave. I think, like Greg said, they're really different things. So I'd be careful about assuming that these relationships held.
Right. So it goes back to your original point, which is understand the underlying market, understand its supply demand dynamics, how it works, how it trades, its calendar. Yeah. Okay. Great. So we have another question. Could you explain exactly what the skew at the money scatter plot was showing again before the Q&A, if you have time? So I think that's for you, Greg. You were looking at that.
Can we bring this chart up?
I think that was that one.
That one. Yeah.
This one or the other one?
It was the skew / at the money scatter plot.
Okay, perfect. This one. Okay. Yeah. So basically what it's showing you is what is the risk reversal doing as at the money vol is changing. So we can basically see that on the x-axis, you see at the money volatility. On the y-axis, you see skew. So you can see as at the money volatility increases on the x-axis in 2021, for example, especially in the first quarter, you can see that the risk reversal skew is increasing, meaning the calls were getting more expensive than the puts. And then on the flip side, in 2022, you can see as vol was increasing, this is 30-day at the money vol, the 30-day skew or risk reversal was decreasing. And so you can see, you can get a kind of a clear idea of the relationship between at the money vol and the risk reversal skew.
Great, thank you. Okay, what is the implied / realized sweet spot for you to sell variance risk premium? Is there a sweet spot to sell variance risk premium? Does anybody want to take that?
Yeah, I can take that. So in the backtest that we ran for systematically selling the straddles on a weekly and monthly basis, we didn't really filter for any sort of regime that the market was in. We pretty much just every week, regardless of where the vol term structure was at or what the variance risk premium was trading at, we just continuously sold that vol just to accumulate as much as possible. In reality, that's probably not the smartest thing to do, because you know, vol could be extremely, the variance risk premium could be very compressed, and that could be a sign of maybe, like, you know, you're not really getting much value by selling vol at that level. And conversely, if the variance risk premium is at like an all-time high in terms of the spread between implied and realized, it might make sense to perhaps increase your exposure to that strategy then. That's a potential idea of like back testing, where you can sort of position size accordingly based on what the variance risk premium is trading at. But at least in this back test, we just wanted to standardize it and see the overall results over the long term without any other rules in place.
Okay. One more question. How do 5-day wings perform relative to 25-day wings? I think this comes back to a little bit what we were talking about before, but
5-day wings in terms of the straddle, or
yes, exactly, a time straddle.
Yeah, I mean, perhaps it might be for the risk reversal, because I mean, selling 5-day or 5 delta straddles is probably not the greatest idea. But the risk reversal in itself, I believe the best returning one was the 35 delta. At 5 delta, I don't think you're really getting much bang for your buck, especially for the risk that you're taking on.
Okay, I think I misread that. I read it, the D is day as opposed to delta. So obviously the question didn't make any sense. I'm sorry.
Maybe it is day. Yeah, maybe I.
Okay. We've got a market structure question, which is interesting. Can you talk about CME options for US-based investors? And this comes back a little bit to what we're talking about execution. You know, how does that change things? Does that change the market? Does it make it more available, more liquid? What do you see, Sam?
Oh, for CME.
Yeah.
I mean, I think the others here are a little bit more experienced in that market to provide a better explanation, but I can comment on the fact that right now the main venue where pretty much all the liquidity is on Deribit, which is like the best platform for liquidity. But I think for institutions to further onboard from traditional markets, they're going to need to go to a venue that they're familiar with and they have already connectivity to. So personally, I think that we're going to need to see more flows there in order for this options market to further develop into more of an established market. But I'll let the others comment if they have any thoughts.
I can touch on this a little bit.
Yeah,
so
come through in the data.
So one of the things that we're in the process of getting that data set at Amberdata, but I still look at it sort of on my own. One of the things that's really interesting is that the BTO ETF, which is an ETF of the CME futures, that has options on it. And if I look at the open interest on BTO, it's about 20% of Deribit. And so that's actually not nothing. And if I compare that to the other CeFi exchanges, I would call that the #2 CeFi exchange. Now, one of the big themes of 2022, and shout out again to Deribit for being such a legit exchange and containing risk. But one of the big themes was the counterparty risk. And so, for institutional adoption, a big problem is custody. For institutional adoption, a big problem is counterparty risk trading at a CeFi exchange. And another big problem is jurisdiction risk. And so sort of the CME solution, especially if you want to trade the futures, well, now you can get long Bitcoin. You don't have to worry about custody. You don't have to worry about counterparty. And if you're a US firm, you can actually trade on this venue. So that makes CME pretty interesting. I think one of the themes that we'll probably see in this next year, in 2023, that would be very interesting to look at is going to be the basis of CME versus the basis on Deribit. Because I actually think institutions are willing to pay a premium in terms of a higher basis to kind of get rid of those risks that they might not be willing to warehouse. And then on the option side, the CME options are still super wide, basically untradeable, I would say. From my perspective, and they're big contracts. There's the micro Bitcoin futures that just came out, and those have options on it, but from just kind of the traditional 5x multiplier, those are hard to trade. And so BTO is actually doing kind of a good service there. And those spreads are not super tight, but they're not horrible either. So that's something that's really interesting for US players to sort of look at. And if they want to trade options, you know, you got to be aware of the contango sort of drop in the futures market and sort of the potential effects that might have on BTO on the underlying price. But there's some options to be traded there. I don't know, Euan, if you have anything to add to that stuff.
I think we've got a couple of problems here around this kind of thing. One of them is massive capital inefficiency, because you can't net out margin between Deribit, CME, or the BTO options, and that's a limitation. The other thing is with the DeFi world in particular, whenever a new option related product comes out, it's always got some funky contractual wrinkle in it. We don't need that. What we really need to do is simplify the on-ramp. We have to make it much easier for people to trade these options. Like, I can bring up BTO options in 10 seconds, you know, whereas to get like a Deribit account, I mean, that's a huge number of hoops you've got to jump through. So I think one of the things that has to happen over the next few years is for all these markets to tie together better.
Yep. Yep. I mean, or dare I say it, join some kind of central clearing process, which sort of defeats the whole point of it. I mean, we've actually got a question of DeFi on DeFi derivatives. How do you think the evolution of the DeFi derivatives space will impact volatility regimes as we currently understand them? And are there any key indicators outside of volume that you're particularly interested in as it relates to DeFi derivatives?
I'm happy to jump in here as well, unless someone else wants to jump in.
Yes, please do.
So one of the things that here's a protocol that I like a lot, and then disclaimer, I own some tokens in this protocol, so I have an interest here. But Lyra is a DeFi options based protocol. It's an AMM based. So I know that sounds crazy. You know, AMMs for options sound like the worst idea ever. But this is a smart AMM that does delta hedging. It reprices based on its Vega exposure, and the trading experience is pretty seamless. Now, how does that affect volatility regimes? I don't know that the size right now is even big enough, even in the CFI space, to really affect anything. But one of the things that's really interesting to look at is you can see the flows against the AMM. And so you can sort of see the net Vega position of the AMM itself. And now all of a sudden you can understand how DeFi degens are basically positioned in the market, just like Fabio and I do at Amberdata, where we look at the flows of on-screen versus block flows, get the real direction, and essentially back out dealer positioning. Well, now you can look at the AMM, that's the dealer, you can see how it's positioned, and then you can basically understand its hedging flows and sort of the counterparty participants, the takers of the market, how they're positioned. So I think that's a really telling thing in the market. It's obviously a small space. There's not a lot of DeFi options traders, but just something to keep in mind.
I mean, it's radically transparent, isn't it?
Mm-hmm.
It's, and that, that should throw up lots of trading opportunities, just that level of transparency. One very last question for Euan. Euan, you've written lots of great books about options. When are you going to write something about classic cars?
The only thing I think I could write there is like a guide to the mechanics who fix them. I don't really have anything else that would be. I mean, it seems quite appealing now, having you mentioned it, but I haven't got any plans.
Okay. Well, on which note, I want to thank the audience so much for all these really good questions. Hard, very detailed, but rigorous questions. I think each of the panelists have given us just some hugely valuable insights into how this market works, what works within that market, how it might look in the future, and what things they are looking out for as this data set expands further. So I want to thank Euan, Sam, Fabio, and Greg. You've all been absolutely fantastic. I want to thank you, the audience. I want to thank Amberdata very much for sponsoring today's webinar, and to CoinDesk for putting this on. And so we will see you at the next live webinar. But between now and then, all the best. Goodbye.